Hello viewers. So finally looks like government is out with the LIC IPO and the IPO will open. So in this video, we'll quickly look at some of the key unique insights about the LIC business and about this IPO through 10 key insights to understand whether this IPO is worth or not. And we will look at some of the popular myths around life insurance industry. We will understand key features and risks associated with LIC business model, some not publicly popular spoken facts about LIC business, and last and most important, how to do valuation for life insurance industry and for LIC. So let us start. So insight number one, this is one of the popular myth on insurance industry, that it is a highly underpenetrated industry, and you will see a lot of news around this 2.53% penetration. But India is not under-penetrated, but under-insured when it comes to life insurance business. And let me highlight it through some of the charts. So if you look at the chart at the top, you can see the life insurance penetration, and India is around 2.7%. Now, though this 2.7% number looks very low, but if you look at even developed countries like Germany or US, they are also around the same number, 3%. In fact, the closest competitor, China, they are lesser at 2.3%. So it's not that this 2.7% is a highly underpenetrated number. And also, if you look at the contribution of life insurance premium as a percentage of household financial saving, it is more than 20%, even though it is decreasing. In fact, at one point of time, it was 31%. So lots and lots of life insurance saving is going into overall saving. So we cannot say that life insurance is not at all penetrated. But what is happening is it is not going to protect the life, and that is why I am saying it is not under penetrated, but it is under insured. And let me show you one more data point. So this data point takes per capita income, because we cannot directly compare India with US. They are very different countries in terms of per capita income. So this x-axis is per capita income, the y-axis is life insurance penetration. And if you look where India is, so if you look India, it's not so low. In fact, in the lower per capita band compared to peer countries, it is much higher. And even if you look at the other countries which are in the higher per capita band, like your Spain, Australia, US, Germany, India is almost there in terms of penetration. So this whole statement that India is under penetrated, that is a myth. But India is underinsured, because when you see India in terms of total sum assured as a percentage of GDP, we are much lesser than US. So in terms of penetration, we are same, but in terms of sum assured, which means lot of insurance, the expense or the spending on a lot of insurance, it doesn't happen for insuring the life, but it is happening more as a saving and investment product. And again, if you look at the protection gap in the right chart, there is a humongous gap. So that is why India is not under penetrated, but India is under insured. Second insight, so we always hear about the PSU to private bank migration. The same story is playing in the life insurance space, where there is a LIC to private life insurance sector migration is happening. And again, if you look at the data, you can look through in the last 13-14 years, LIC has kept on losing market share, except that 2011 to 14 period, when the regulator came heavily on the ULIPs, where private sector were having a lot of ULIP products. But again, after that, private sectors, they realigned themselves. And in last 7 years, LIC market share has gone down from 64% to 48%. So this mega trend of PSU to private or LIC to private is there. Third key insight, the LIC market share, because when you read about a lot of articles on IPO, you will hear that LIC market share is very high, around 64%. But when you look at the business market share in terms of the new business growth, also when you look at the quality of growth LIC has shown recently, I think there are key important questions there. And again, let me highlight with the data and chart. So first, when you look at the LIC APE mix, and APE is annual premium equivalent, which is basically your annual new reoccurring premium plus 10% of the new premium. And why they take it? Because sometimes you could have a single premium, or sometimes you could have a premium which is spread across the year. So how do you normalize it? So that is the way to normalize, where you take the whole existing premium of a year plus 10% of new premium. So when you take this, basically it reflects the latest new share of business. So when you take this mix, you can see in last 3-4 years the share of the group premium has increased. And when you see the individual premium versus group premium, the margins will be higher in the individual business, because that is retail business, that is more sticky business, there is a higher margin. The growth is coming more from the group and lesser from the individual. That is one. The next chart, when you see this, this is the mix of individual and group. So last chart which you saw, now we are seeing for LIC and for other companies, what is the breakup of individual versus group. And when you see this number for FY21, you will see, even though the total premium individual for LIC is 66% and the group is 33%, when you look at the business from a new business premium perspective, the new premiums which are getting added, this ratio is just opposite. The individual is just 30%, 31%, and the group is almost 69%, which says a lot about the difference in the market share which is there earlier versus the current new business premium market share, which is more dominated by the group, which is a lower margin business. Fourth insight, there is a high concentration of LIC business towards par portfolio. And again, insurance is a very complicated business in itself. There are various kinds of products, depending on whether it's linked or non-linked, whether it is a saving product or it's pure insurance product, term product, whether it's participating product, non-participating product. So in this video, I cannot get into all the details, but all I can say is having a diversified product portfolio, a good mixed product portfolio is always better, because every product has its own pros and cons. So coming to LIC books are not diversified. It's highly concentrated towards participating product, and usually participating products are low VNB margin products. Again, VNB margin is important. Again, I will not get into detail, but VNB is value of new business. And if the margins think it like a profit margin, if the profit margin is high, that means the company should be valued in a better way than companies with low margin business. So of course, a high VNB margin company in life insurance should get some kind of valuation premium compared to a low VNB margin business. Also, it's a participating product, and it's not an asset light product. There is certain amount of balance sheet risk which lies with the life insurance company, compared to a ULIP, which is more like a mutual fund type of business where the balance sheet is very asset light. So again, if we look at the VNB margin, now a high VNB margin is good and low VNB margin is bad. So if you look at the product, all the protection products, pure protection products, they have very, very high VNB margin. And ULIP product is very low VNB margin, and group products are lowest. So you saw you saw how LIC is, individual versus group, new business equivalent is changing. And now you can see the participating product margin is on the lower side. Even though ULIP has lower margin, but in ULIP, you don't have a balance sheet risk. But in participating, you have a balance sheet risk, because you are saying that you are going to give some guaranteed return, but you carry that risk to generate that return. Also, you can see the VNB margin of ICICI Prudential, SBI Life, HDFC Life. All of them, they have around 14 to 22% VNB margin. But when you look at the VNB margin of LIC has only 9 or 9.5% VNB margin. The fifth insight, which is as I highlighted, the VNB margin is key to valuation, and LIC is far behind there. And you can see that VNB margin for LIC has been around 9.3, 9.9%, whereas for other companies, the same margin is around 14 to 23%. So we cannot compare it directly. The sixth point, LIC is a primarily agent-based model. So you saw in terms of product portfolio, LIC was not diversified. They were heavily concentrated towards participating. Even in terms of distribution and the channel, they are not diversified. They're primarily agent-driven model, which means they lack channel diversification. Why I'm stressing on all these points is because the more never ever one same line of business or same channel line or same product will do very good or very bad. It always goes through its high and low period. So that is where diversification helps. But not having diversification when the bad time is that it gets impacted. Like when you had COVID, there was a significant reduction happened in the agent count because people couldn't move out and agents maybe they couldn't sell. So if you see LIC, 93% to 96% of policies they are getting generated through the agents. Whereas again, if you look at the private sector, it's much more diversified where the agent share has decreased to 30%. There's a bank channel, then there's a direct channel, and your direct channel will be a higher margin channel. Your digital channel will be a higher margin channel. And at least right now, LIC, the direct and digital share is almost negligible. So again, this is a risk, and also it doesn't help from the margin perspective. But let us look at the investment side of business, because the business of any insurance company is to collect the premiums and then invest it into FDs or equity, and then generate return, which is called float, and then they make money, and that is how the business works, apart from making underwriting profit. So if you look at what percentage of investment LIC does in debt product versus equity product, the equity share is quite high right now. The share is almost 25%. Usually I have seen private players keeping it lesser than 15%. And more the equity share, more it will be dependent on equity performance and vagaries of the equity market. So the returns, the yield might look higher, but one reason could be because they have a higher equity exposure, but that it comes with own set of risks in terms of the volatility of equity and all of that. The eighth thing is the gross NPA part, because we hear about NPAs only in banks, but even in insurance, the investments which are there, the insurance companies, they invest into bonds, they invest into maybe road project, infra project, and then some of the investments can go bad, which is again NPA. And if we look at the share of gross NPAs of LIC, I find it very high at around 6 to 8%. Though they are doing provisioning, it tells something about their allocation skills, their investing skills. And again, I don't remember I have seen such high gross NPAs again for leading private players. So why am I highlighting all these points? Because everybody compares LIC with the private player valuation, and then they will say that this is 50-60% cheaper to private players. But why it is cheaper, there could be reasons, and I'm trying to find and highlight those reasons. So again, we need to keep monitoring how they are managing their investments and their NPAs. The ninth point, the annual premium equivalent, which has been a mixed bag. So we saw that actually what is happening here, the things are changing very frequently. So if we look at 1 year of data from April 20 to March 2021, Feb 21, LIC lost business on annual premium equivalent, 12% fall. Again, one reason I could attribute is maybe agent-based model and that risk. But what has happened in last few months, again, LIC has started gaining that AP market share. And again, it has gone up, in fact, 55% from 35% of December 2021. So we need to keep monitoring these things. But considering all of this, you looked at, the LIC business, first, the overall insurance industry, because everybody talks of growth. But of course, there is a growth in terms of saving, but not in terms of under penetration, and growth in terms of, underinsured. Also, we try to understand how LIC is different from all the players in terms of product, in terms of investing, in terms of NPA management, in terms of equity versus debt, and in terms of new business versus old business. But let's now finally come to the valuation. And 3-4 months back, LIC IPO was supposed to come, and the kind of valuation LIC was coming at that time versus now, there has been a significant change, and it looks like LIC valuation is cheaper, which is around, I think, 1.1, 1.2 embedded value. But there is a quote that "Sasta matlab acha nahi hota." So what I have seen historically, usually in the long run, it is the leaders which create wealth from a long-term sustainable perspective, provided one buys them at fair to attractive valuation. The number 3, number 4 players, they occasionally become mispriced bets because of valuation attractiveness, and they create, give alpha for some time, but it doesn't work all the time. So I feel SI falls in the second category. It may or may not, give decent returns, because, of course, on one side, the valuations are much lower than private players, but then there are reasons for it, and let us try to understand it. So to understand valuation, again, valuation of a life insurance company is a very complicated topic in itself. I have tried to simplify it. So remember these 3 terms: embedded value. So take embedded value as basically, if you take any stock, you'll do a DCF, discounted cash flow. Think in terms of DCF. And in DCF, what you do, you take all the present cash flow, and then you take all the future cash flow, and you find the net present value. So LIC or any insurance company, life insurance, they have collected a lot of premium, and there must be some valuation tagged to that premium collected. So embedded value is the net present value of all the future profit which could be generated from this current business and the net worth. So it is more about the present value of all future cash flows from the present business net worth. But in next year, year 1, year 2, year 3, year 4, these companies will keep getting new customers and new business, and again that business will generate profit. So that part is called VNB, value of new business, which is net present value of all future profit generated from future business. And again, there is a lot of accounting and complexities. I'm not getting into it. Many things I also don't understand, but I'm just trying to simplify. So from a valuation perspective, these 2 things are important here. So any valuation will be current book profit and future profit. So your current profit comes from embedded value, and your future profit comes from VNB. Now there are 2 popular techniques of valuing life insurance businesses. One, you can directly give a multiple of embedded value, and that is what you will see in a lot of articles where they say LIC is getting now 1.1 or 1.2 embedded value. The other way to value is you separate the current business and you separate the future business. And instead of giving a multiple to EV, which is more current business, you keep it as it is. And then depending on the growth trajectory, you give a multiple to the VNB side, which is the third line. And I read some white papers on how, globally this has worked. And what I have seen is usually companies, they get a VNB multiple of 10 to 30, of course, depending on lots and lots of factors, like when I said the VNB margin, the growth trajectory, and all those things. So when we look at LIC, one thing is there, LIC is coming with a 1.1 times price to embedded value. And this is much cooled off valuation compared to what, LIC was charging earlier 3-4 months back. And with this, the valuation comes around 6.07 lakh crore. So if we try to put in our valuation framework, and if we look at the LIC current VNB business as per FY21, almost 4,167 crore was the VNB business. So now if you take this valuation approx at 6.1 lakh crore, and the current embedded value of LIC is 5.4 lakh crore. And as I said, there is lots and lots of accounting. So there is an interesting article itself on the curious case of jump in LIC embedded value. Again, you can just Google Mint the curious case and you will get that link. Try to understand. There's a lot of accounting involved. But let us assume 5.4 lakh is the embedded value, and 6.1 lakh is the current valuation, and almost 4,500 crore is the VNB. So what is the multiple LIC is charging for VNB? So basically, if you see, this multiple will come as 16, because 4,500 crore into 16x become that almost 70,000 crore added to 5.4 lakh crore embedded value, and get 6.1 lakh crore. So as I said, that X VNB X lies between 10 to 30, and LIC is somewhere in the middle. If you look at companies like HDFC, when HDFC was trading at peak valuation, I think 650 plus, I think that number was somewhere around 38, 40, and then it cooled to around 30. ICICI corrected recently and it touched almost 17, 18 VNB multiple. And then again, I think it has gone 25 plus above. So I'm giving you some numbers for reference of the private sector. You know, the difference between, you know, the type of business, the diversification of business, the diversification of channel, the difference between VNB margin and all of that. And then you can take a call based on valuation, the difference, you know, which company is a better company, and you can look at whether to invest in LIC or not, take your own individual call. So I hope this session was useful. I will see you again with a new video. Thank you.